What's going on, everyone? In today's video, we're going to break down a concept that quietly dictates market movement every single day: the dynamic interaction between internal range liquidity and external range liquidity. Now, before we jump into the charts on TradingView and look at some real examples, we first need to build a strong foundation by understanding what these terms actually mean and how they operate within market structure. All right, let's start with the basics. Internal range liquidity refers to the inefficiencies inside of a price range, most commonly identified as fair value gaps or imbalances. These represent areas where the market moved too quickly, leaving behind unfilled orders. The price often comes back to rebalance. On the other hand, external range liquidity exists at significant turning points in the market: the major swing highs and the major swing lows. These areas hold clusters of buy side or sell side liquidity created by stop losses and breakout traders positioned above highs or below lows. Now, once we understand each individually, the next question becomes, how do they actually interact? The truth is that the market essentially operates in a repeating cycle, driven by two core objectives: take out liquidity resting at old highs or old lows, and return to rebalance inefficiencies inside the range. Because of this, price often follows a predictable sequence. After the market sweeps external range liquidity, meaning it takes out a previous high or a previous low, it usually transitions towards internal range liquidity to fill the imbalance left behind. Once that internal range liquidity has been satisfied, price frequently continues the cycle by reaching for the next pool of external range liquidity. For example, once price grabs liquidity above an old high, what's the next logical target? The fair value gap sitting inside the range. After the imbalance is filled, where is price likely to head next? The next set of external liquidity may be a low sitting just below the current structure. This rhythm, external to internal, then internal back to external, is what creates the market continuous ebb and flow. Understanding this relationship gives you a huge advantage because it allows you to anticipate future price objectives instead of reacting to every candle. Now that we've covered the theory in detail, let's jump into the charts and break down several examples so you can see the exact sequence playing out in real time.
Okay, now let's go ahead and take out a look at the 4-hour time frame on the Australian dollar versus the US dollar. And let's see how price goes from internal liquidity out to external liquidity. So here we have this 4-hour sell side liquidity, and we are anticipating for price to come and sweep this liquidity. So let's go ahead and see how price plays out. And just like that, price sweeps this sell side liquidity. And where is price most likely to head next? Price has two options. Price has this fair value gap up here and this fair value gap right here. So let's spread it over and see which one price goes towards. Okay, so price completely ignores this fair value gap, and that now is out of the equation. So the next area where price is most likely to head and reverse off is this next 4-hour fair value gap. Let's see how price plays off of this zone. And just like that, we have a nice bearish reversal candle from off this zone. And that shows us that price is intending to reverse. So now what's the next target for price to head towards next? We have this 4-hour sell side liquidity. And this is what price is going to lean towards next. So let's see how price plays out. And boom, just like that, price ends up sweeping this liquidity. So since price took this liquidity out, where is price likely to head next? We have this nice 4-hour fair value gap here. So we're anticipating for price to come back into this range and then back out. Let's see how price plays out. All right. All right. So price returns from external liquidity back into internal liquidity. Now, where do we anticipate for price to head next? Price is anticipated to head for this 4-hour sell side liquidity. And now let's see how price plays out. And just like that, price goes from internal liquidity back out to external liquidity. All right, now let's take a look at a next example. We're taking a look on the pair of Euro USD on the daily time frame. Now, on the daily time frame, we have a clear swing high or buy side liquidity. Now, let's see how price reacts as soon as it takes buy side liquidity. So, we swept buy side liquidity. And now the question is, after we swept external liquidity, where is price likely to head next? And the next zone where price might head next is this fair value gap made on the initial push to sweep buy side liquidity, resting above this high. So let's see how price plays out after sweeping buy side liquidity. And price then returns into internal liquidity. Now, since price has returned back into internal liquidity, we are looking for price to go back out to external liquidity. So let's go ahead and fast forward some more. And just like that, price sweeps liquidity from the buy side, returns back to internal liquidity as a fair value gap, and then goes straight back out to external liquidity. So we have from external to internal back to external. All right, that's going to wrap up today's breakdown. If this helped you understand the flow between internal and external liquidity, be sure to hit that like button and subscribe for more deep dive trading content. And if you have any questions or want me to cover a specific topic, drop it in the comments. Thanks for watching, and I'll catch you in the next one.